All right. Hello. Welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm here with Renji Matthew as always. And today we're going to be chatting about and talking about what you should do if you just bought a house. What are some smart financial decisions that you should make that will allow you to build wealth, but also protect your number one most valuable asset? Because a home is going to be the largest purchase that most people will make over the course of their life, right, Renji?
Yep, it's probably the biggest purchase they make other than their car, right?
Yep. So how can you be smart with your money and protect your asset? And that's what we're going to talk about today. And so I'll actually start it off by saying, number one, when you first purchase your home, you're going to be inundated with a lot of paperwork as it is, right? But one of the smartest financial decisions that people can make to protect their number one asset, because financial planning 101 is risk mitigation, aka how do I cover my bases in case the worst case scenario happens? And for a lot of people, that is, a loved one or a spouse passing away. Or what about you or your spouse, having a major medical event? If you're married and you guys are buying the house together, you want to make sure that you protect your asset. Now, most people think that they have some type of protection to cover this, but there's two types of insurance that mortgage companies offer on your home, and that's PMI and then traditional is homeowners insurance. So let's talk about what PMI and homeowners insurance does. PMI is actually a totally separate insurance policy that doesn't necessarily protect you, but it protects the lender if a borrower were to default on their mortgage. So that's what's usually required if you don't have a down payment of about 20% or more, because the lender sees this big amount of you're borrowing a lot of money for this asset where it's not really worth much more than what you just borrowed it for. So there's a lot of liability on the end of the lender. So that's PMI. It protects the lender in case you were to default. Homeowners insurance, of course, protects the house if anything happens to the house, like a fire, natural disaster, maybe somebody breaking in, maybe flooding, and so on. And then lastly, mortgage protection insurance is what covers your house or covers you and your family financially if something happens to you. If you pass away, if you have a heart attack, stroke, cancer, anything major like that, it's going to be there to pay you or your spouse or your loved ones this benefit tax-free that you can use to help pay off your mortgage or just continue making the monthly payments. Because here's the thing, we're going to talk about some other strategies to maybe help you pay it off sooner. But the bank, the lender, every single month, all they need from you is your monthly mortgage payment. So if you're sending them more to try to pay it off sooner, I talk to a lot of people that have a $2,000 a month mortgage payment. They send like maybe $2,500. They're sending that extra $500 to the mortgage company or to the lender, but there's no extra additional benefit to you. And here's what I mean. Let's say something were to happen to you medically, like cancer or a heart attack or a stroke. There's going to be a period of time where you cannot work. You may have some disability insurance from your company. If you own a business, you may not have anything like that, right? Everybody's situation is going to be different. But here's the one thing. If you try to go to your lender and ask them for some forgiveness or for some type of grace period, they're not going to give it to you because they always want your $2,000 a month for your mortgage payment. So mortgage protection insurance can come in and help you in the event that something like that happens, where if you can no longer work, you can now tap into this death benefit because it is a life insurance policy, and you can use your death benefit while you're still alive. Most people don't even realize that life insurance can do this, but mortgage protection life insurance is one of the top strategies for leveraging life insurance to actually protect, your number one greatest asset, which will be your house. So the way it works is typically if you have a 30-year mortgage for $400,000, you would get a life insurance policy that matches it, a 30-year term policy for $400,000. That way, in case anything happens to you or your spouse, if you're married, over the next 30 years, your mortgage is covered. It'll be paid off family doesn't have to worry about it, and so on. Right. So with with that, Renji, is there anything I missed or anything that you wanted to add on for us?
One of the things that I hear a lot from clients is, oh, I have insurance at my work, short term, long term disability. But what a lot of people don't think about, let's say you had cancer, and this has happened to colleagues of ours that have had family members and other clients of theirs, this has happened to them, where they didn't get something like mortgage protection because they thought the coverage they had at work was enough. The problem is most coverages that you get at work, it's a group policy, right? Because it's a group policy, it's going to be the cheapest thing you'll ever find. You won't find anything cheaper outside unless it's like an accidental policy or something. But it only covers at the point of death. If something happens to you where you have chronic critical or terminal illness, there's no money to access there. That's where short-term and long-term disability comes in. But think about this. What if, and this is what happened to our colleague, his aunt I think she had a life insurance policy where she would get 3 times her annual income if she passed. She had cancer, and her short-term disability at work covered her for 6 months. So most people don't realize the difference between short and long-term disability. Most companies, and this is not standard everywhere, but this is on average, short-term disability covers you for the first 6 months. Long-term disability covers you for the next 6 months. So your long-term and short-term disability is pretty much done after a year. Again, this is not every company, but this is average what you see. After that 1 year mark, your company, if you're still dealing with having to go in for treatments or can't work or whatever, they're going to have to let you go because they won't be able to cover you for, they can't just keep an employee without having to work, right? So most of the time, they will probably let you go after that 1 year. At that point, you lose your insurance, you lose your life insurance, your life and health insurance. What are you going to do at that point? This is where mortgage protection insurance comes into play. And mortgage protection is a life insurance policy. It could be a regular term. It could be any type of policy, depends on your goals. But most of these, they have chronic, critical, and terminal illness. So in this case, in this scenario, when she had cancer, she could have tapped into that death benefit to pay for her bills. She could have tapped into that so that her and her family won't get into a financial bind when she's going through her hardest period of going through cancer treatments, because chemo and radiation is not fun. And on top of that, you don't want to have to deal with financial struggles too. And at the worst case scenario, if something happens to her and she's gone, now, because you had something in place, their family doesn't have to struggle when they're going through a sorrowful time, right? So there's different things to consider there. Anything you want to add to that, Kyle?
No, that's perfect. Nothing that I wanted to add, but that's like the protection side, how to protect your most valuable asset. Let's start to talk about some different strategies to help people pay their house off sooner. And then once we talk about that, we'll talk about some ways to actually turn your house into an asset that starts, that can actually help you start getting passive income, right? So what are some strategies to pay your house off sooner? One of them actually can still be utilizing mortgage protection. If you work with somebody that is a broker and that understands how to design these type of policies, it can be designed so that in 20 or 25 years, your house still gets paid off while still having that mortgage protection coverage that most people want and are seeking to have anyways, right? So you need to work with somebody that's licensed. Renji and I are both licensed as brokers that can help set these kinds of policies up. If you guys want to chat about those, just send us a message here on YouTube, or you can go connect with us on other social media platforms. But that's one way to pay your house off sooner while also protecting it. Another way that most people don't know about, Renji, is like making payments every 2 weeks instead of once a month. Can you talk us through what that is and how that works?
Yeah. So what that does, if you're doing a payment every 2 weeks, so let's say your mortgage payment is $1,000, just to keep math simple. If you're doing $500 every 2 weeks, At the end of the year, you have one extra payment that you've made. And it's just, so going back to one of the things Kyle mentioned in the beginning, if you're putting, let's say your mortgage is 2,000, you're putting 2,500, the whole goal of putting that extra into it is to pay the mortgage down earlier, so you're paying less in interest, right? So if you do it this way, it's doing similar, it's the same thing. It's just a one extra payment that's paying it down, and it's less of a hassle on you because you're not paying a whole 1,000 all up front. You're paying half of that every 2 weeks. Yeah. So especially if you're living paycheck to paycheck, or you're getting paid every 2 weeks, this will be less of a stress on you too, because you're not paying a whole 1,000 up front.
Yep. So that's another way to help you pay off your house sooner. And it's kind of funny or weird, I guess, how the math works out. But yeah, over time, if you pay it every 2 weeks instead of just once a month, you would end up making 26 half payments, which if you divide that by 2 equals 13, technically 13 like full payments that you would have made into the full year. So that's how you can start to pay off your house sooner. And I think when you do that, actually, based on the math, I think you end up paying it off like 3 to 6 years sooner. I'd have to double check the math unless you know, but I think it's you shave off multiple years.
Yeah, it depends on if you have a 15 or 30 year and what your interest rates are. But yeah, you can, again, depending on how the lender has it set up for you.
Absolutely. So that's some different strategies to help you pay off your house sooner, to be debt-free from your house. And with that, a couple other ways that we can actually start to turn your house into an asset is through house hacking. And then also the way Renji got his start into real estate is by taking a home equity line of credit to be able to fund his purchase of his real estate. So Renji, if you want to talk about both or just pick one or the other, let's talk about house hacking and the HELOC.
Yeah, so we were, I think we've talked about this a little bit before. We were huge Dave Ramsey people. So we were all about paying down the mortgage as fast as we can. And we were doing that. We were paying double the mortgage sometimes. We would live off of my wife's income and put all of my income into paying down the house and investing. And once because we did the math and we had a 15-year mortgage, we would have paid off the house in 5 or 6 years, and we would have saved $47,000 in interest. But what we learned later, knowing what we know now, if I would have just paid the minimum and put that extra into cash value life insurance, I would have had $500,000 conservatively. Yes, I would have paid $47,000 in interest, but I would have made $500,000 in tax-free income too. But on the other hand, the part that it helped us, because we were paying double the mortgage, is now I had enough equity in our house. So when we wanted to get into real estate, we had enough equity in the house that we took the equity and we put down payments on our first couple rental properties. So that's another thing. So Kyle mentioned house hacking. We talked to so many people that have either duplexes, or they live in their house and they fix it up as they live in it. Fix up parts of the house at a time or rooms at a time, and then they rent it out. Or once they're finished fixing it up, and they sometimes do it over a course of the year, so you're getting to do what you want, but not in a rush either. After that, they get their next house. Now they rent the first one out. That's what house hacking really is. But we know people that have had duplexes where they live in one, they fix up the others, and they rent it out. Now they're one side is paying for their mortgage pretty much, so they can live for free if they want. But if they also make a payment, now they're paying down that mortgage faster, right? So just having equity, the cool thing about having equity is now you can leverage that equity to buy another rental. And the hardest part is getting into real estate. And this is with any business. The hardest part is to get started. But once you get started, it becomes easier because now you can leverage your portfolio of properties to get a bigger line of credit. And now you can get more properties faster. This is what a lot of the wealthy do, is they start with single family homes or small units first, or storage units or whatever it is. And once they have enough, now they can get a big enough line of credit and they can get apartment complexes, or they get big enough where they can sell all of it and use that cash and do a 1031 and buy an apartment complex or whatever. So it takes a little bit longer, but it's about the journey to get to where you want to instead of trying to get a quick fix on what you want now, right?
Absolutely. Another way to house hack too, one of my buddies did it, is when he bought his house, he rented out bedrooms to his friends. Yep. You can rent it out to siblings, to I'd be leery with people you don't know, but maybe coworkers or something. But think about, if you have a house and you have extra bedrooms, maybe you're not using, you can rent it out to other people, and then they're paying you, to help you with the mortgage payments. But really, that's helping you build equity quicker, especially if you weren't going to use the rooms anyways, right? So that's just another way or another idea to think through of how to house hack, how to turn your home that's already an asset into a greater asset, that one that's actually producing you income as well. And then Renji, I think the last thing that we should talk about, because we've talked about how to protect your most valuable asset, how to pay off your most valuable asset sooner, how to take that asset and then actually earn extra income or get into other, assets that are going to produce you passive cash flow and income as well. I think the last thing we should talk about before we wrap up our show is how to protect your assets for the long run by opening up like trusts and why we should use trusts. And we've talked about this before, but on this episode, we should go in specifically on a home and why it's so important. So can you tell us, why having a trust may make sense for people that, want to pass on these assets to family members?
Yeah. And like you said, we mentioned it before, but the way it works right now, if you don't, let's say I have this house and I don't name my son as the beneficiary of the house if I pass away, or if I don't put it in a will or a trust. Now, the trust will give you the biggest protection because a will can still go through probate. So you could still have issues, and a probate court, they can keep you held up for a year or more. I've known of clients who's been in court for 3 years to get and in their case, it was retirement accounts and stuff like that. But a trust will protect retirement accounts and houses and everything from probate most of the time. I think all the time, pretty much, because you're setting it up, saying, "Hey, this is who will get my house when you're gone." What a trust does, it gives you control even when you're gone. So you could set it up to say, this is what will happen to my business. This is what will happen to my house. This is what's going to happen to all of this retirement accounts. So it gives you control for when you're gone. If you don't put that somewhere, then that's where probate happens, right? The government loves to take things, especially if you don't name where it's going or whatever, right? So it's all about protecting you and your family from your hard-earned assets going somewhere else. And you can also protect your family. And this depends on your state and what kind of assets you have. You can also shelter your loved ones from taxes, not fully, but partially. Again, depends on what type of asset it is and what state you're in. But a trust can also protect them from tax liabilities also.
Absolutely. And so that's really the last part of, protecting your assets and protecting your home, especially. And so with that, Renji, I don't know if there's anything else that you wanted to add, but I think this has been a good show. Keep it short, keep it simple, and just some different strategies to help people along their journey of being a homeowner. Anything that you wanted to add, though?
Yeah, the only thing is, guys, it's all about planning, right? Any of this that we're doing, it's just education. That way you guys can plan better. You want to make sure you have plans set in place to protect yourself and your family if anything happens to you. Because at the end of the day, we do all of this to provide for our families and loved ones, right? So if you don't have plans in place for if you can't work anymore, or at worst case scenario, if you're gone, what happens to your family? If you have plans set in place and have those discussions with your loved ones, Yes, it's still going to be a struggle when something happens to you, but at least they have a plan in place so they're not in utter turmoil, right? At the worst time of their life, where they're grieving your loss, they at least have a plan in place so they're not having to deal with the worst things, like losing a house or, all of these things. So that's all I want to end it with is plan. This is all about planning.
Yeah, you actually just sparked a thought through my brain. Like, people, you can either have a plan that you're leaving for your family members, or you're leaving your family members to just figure it out. And now many Americans have just left their loved ones to figure it out, and they can get by, they can figure it out. But here's what figuring it out looks like to me. It is them going through stress, having extra anxiety, having to pull and borrow funds, maybe from other places to be able to take care of, final expenses and just other things that happen and other costs that come up when something does happen. So instead of just having your family figure it out without you, put a plan in place to protect them and just to make the process easier for them. Right. And vice versa, if it's with a spouse or another family member, maybe your parents. Like, failing to plan is planning to fail, is what I've always said. If you don't have a plan, you're going to have to figure it out, and it's going to be crazy and chaotic when it could be so much simpler. And oh, by the way, if you plan beforehand, it also saves the family a lot of money. If you don't plan, if you don't have a plan, there's going to be so many extra expenses that come out of it. And planning beforehand can save thousands and thousands of dollars as well. So want to thank you guys for tuning in. Hopefully you got some good information out of this podcast. If you just bought a home, number one, congratulations. But number two, take some of these tips that we just and strategies that we just shared and actually start to build wealth. Protect your wealth, build your wealth, and continue to scale it. If you guys like the information that we provided in here, you're going to love our school community. We'll drop the link below. It's called the Wealth Academy. This is where Renji and I have done hours of content educating on how to build wealth starting from nothing, how to protect your wealth. And we've also interviewed now 5 or 6 guests that are sharing their ideas and their stories about how they're building wealth and their lessons that they've learned along the way. So we would love to see you guys on the inside. There is no cost to it currently, but we can't make any promises for what the cost may be in the future, because Renji and I are constantly pouring value into that and looking to scale it and grow it larger. So we'll see you in the school community. Thank you guys for watching. Be sure to like this video and subscribe, and we'll see you on the next one. Take care.